Hello, this is our first auditing class. In today's class, we're going to talk about why auditing is necessary. It's important for the society, and we're going to talk about the parties involved in auditing process and what are the means companies, entities take to improve audit quality, and why should a good auditing benefit the society. And we're going to briefly talk about the audit firms themselves, because we are accounting major, and for most accounting students, I think audit firms provide a pretty good training to fresh graduates. So we're going to talk a little bit about these as well. Like I explained in our meeting, in my class, usually I expect students to take initiatives to read a book. Right? You are not paying me, as a school is not paying me to read an English book to you. My job, I think, is to supplement what you read with something necessary to help you understand the book for sure, but also to supplement the book with my 2 cents about the business, and then with some information about how the work is done in real life. So let's start this class. First, I believe most people have heard, if you turn on any accounting class, they will tell you accounting is business language, or is a language of business, right? How do we understand this? I will give you an example. So from there, and then we can get some more knowledge about auditing. So here we have company A and company B. And assuming other information, other financial statements, other on the balance sheet, other components are the same. So the only difference would be PPE, property, plants, and equipment. So if you recall, what's about a PPE is, PPE has to be presented when we do financial statements. PPE has historical cost and accumulated depreciation. And the net PPE is the difference between the two. So I guess many people, I'm not sure if you wondered or not, but to me, I was wondering, right? We know that accumulated depreciation is a contra asset item which need to be subtracted from historical cost, which means when we think about the total assets, only net PPE affects total assets. Right? So some people might be thinking, hey, if only number-wise, mathematically, if only net PPE matters, why do we go through such trouble to calculate accumulated depreciation and to put both historical cost and accumulated depreciation on financial statements, right? So let's use this example to take a look. With the information on the screen, let me make it larger. Can you tell me which company is better? I mean, the best we can say, I guess, is I don't know. Why we don't know? Because we only know net PPE and they are identical. So we really don't know which one is better, or they are equally better or equally worse, right? But we know, if we recall, like I said, when we present PPE, GAAP, generally accepted accounting principles require that PPE to be presented in the form of historical cost first, then contra asset, which is accumulated depreciation next. Then the difference, if we subtract accumulated depreciation from historical cost, we will get net PPE. So those things cannot be omitted. So let's assume historical cost of PPE for company, let's add one more zero, for company A is one, okay, another one more there. For company A is 10 million, right? So accumulated depreciation is 5 million. Why do I always? So, which means, okay, historical cost, 10 million, accumulated depreciation, 5 million, net PPE, 5 million, no problem at all. So for company B, let's assume historical cost is, oh, I always miss one, is 6 million, and accumulated depreciation is 1 million. So the net PP is also 5 million, still 5 million. So let me ask you, which company seems to be better? Right? I mean, we might not agree with each other, but at least we can say that based on the information we have, based on this information, we cannot say they're the same, right? There's difference. And in what way it is different? And we know that given the information, we know that a company A, 50% of the PPE has been used. And for company B, we know that only maybe 16%, 17% has been used, right? How do we know that? If we divide accumulated depreciation over historical cost, right? We get what we want. Accumulated depreciation represents what has been used, and historical cost represents when it was originally, at the first day it was put to use. What was the book value of it? So here we go, all right? So to me, maybe company B is in better shape because we know that when PPE is fully used, companies have to spend money, not necessarily cash, but it has to purchase new PPE or REITs or whatever. No matter what, they have to take up cash flow, right? So in this case, we know that 80% of company B's PPE can still be used, while for company A, only half left ready for use. So without considering other information, I would say that company B might be in better shape. I might like company B better, right? But if we recall, there's also an issue with this, is that when we talk about PPE, we have to talk about useful life. What is useful life? Useful life is for how many years this piece of equipment, PPE, can be used. Right? So if we kick in that information, maybe it's going to be different again. And it's keep in mind that this is required by GAAP, right? When you are presenting financial statements, you have to disclose, companies have to disclose useful life, right? So that's here. Let's assume for company A, the useful life is 20 years. And this is not a percentage fund. I'm not sure what I did. Okay, it's 20 years. And then let's say for company B, the PP's useful life is 6 years. Okay? So now let's think about it. The useful life for company A is PPE is 20 years and 50% used already. So meaning the life left is 10 years, right? And the useful life for company B's PPE is 6 years. 1 year has been depreciated already, 1/6. So the remaining should be 5 years. So now, which is better? We know there's difference, right? Why? Because although 50% of company A's PPE has been used, but company A's PPE has much longer useful life, 20 years. So although only 50% left, still they won't be replaced until 10 years later, right? However, we cannot say the same for company B because although only 17% of company B's PPE has been used, but company B's PPE has useful life of only 6 years, and 5 years later, they're going to have to replace the PPE. So in this way, maybe company A is better again, right? You might not agree with me about which one is better, but I think we should agree on that. The information with the new information, we might make different decisions. Now we are talking about a business, right? When we talk about accounting, right, we are talking about companies communicating their information to those who rely on financial statements. That is, let me turn off this light. With more information, companies can figure out by looking at financial statement, users can figure out by looking at financial statements which company is better, which company is worth investing their money in, or which company they feel more comfortable to lend money to, or to set what kind of interest rates. So they feel safer, feel better to make the deals worthwhile. Many people rely on financial statements. They need financial statements to provide them with financial information so they can make decisions, right? So accounting is a language of business because companies, entities use financial statements, financial accounting information to communicate their information, their performance to other folks, right? That's what we are talking about. So since we are talking about communication, and we always know what is the issue with communication. The issue is when you are listening to other people, and when people are being communicating, right? You cannot take other people's words. Take it word by word. You cannot just take their words. Right? Why? Because companies act in their interest. Right? They need investors to lend money to them. They need investors to invest in them. Right? They need investors to buy shares so their companies appear to be better and they can profit from it too. So now we know that the interest of those who use financial statements to make decisions, right, is different from those people who run the companies or from the companies. So how do we do to take care of it, right? And the first, before we go there, let's talk about why this would happen again, okay? So we have a few reasons, right? We said with communication, if we use language, right, to communicate, we might be cheated. Some people might cheat us, right? And why this would happen? A few reasons here. We all heard about the capital market. We heard about heard about American exchange, and we all heard about the NASDAQ, right? And what are these? These are stock markets, right? We buy stock from different companies from stock market. The company might be in Louisiana, the company might be in New York, the company might be in California, or might be in Europe, right? We don't have to be physically there to invest. However, one issue is if you are not physically there and you cannot monitor a company's operation every day, how do you trust? You can only rely on what the company tells you, right? And how do you trust it? That's issue number one. We don't know. You see that? And issue number two, right? And we thought of this, companies, when they release why they need to release financial statements to convince other people they are doing well? Because they want different things from investors, right? They want their stock price to go up, and they want banks to lend money to them, to continue lend money to them, maybe to even lend more money to them, charging lower interest rates. And why banks would do that, or when banks would do that, when they see from companies' financial statements that the companies are doing well. So even those companies who doesn't do well, they still have a strong interest to lie to get more money, right? Or to get those fundings, to get a better interest rate, to get a higher stock price. Right? So, however, as investors, what we want is stock price to be low as possible, or at least to be fair, right? So there's a difference, right? Those companies will always act in their own interest, even if without the regulation, even if they are doing bad, they will still tell you, hey, we are doing well, and we are no stranger to such information, given we have SEC and they are announcing those sanctions against different companies every year. So this is issue number two, right? Companies will lie. They act in their own interest. And if we think about the third issue, it is quite understandable as well, right? We are in accounting major, and you pay money, not cheap, to understand accounting. And most of you, when you graduate from college, from university, you will still feel you don't know much, right? So accounting is not something, it's not difficult, rocket science, but it's definitely not something very, very straightforward for anybody to understand, right? There's complexity about that. Right? And if you look at accounting, look at a GAAP, look at the generally accepted accounting principles, and look at those guides for manufacturing accounting, for bank accounting, accounting itself is not so straightforward, right? And the company's businesses is getting more and more complicated. If you look at Walmart is not just selling groceries, right? They also sell TV, and they tell you, hey, no worries, if you can pay today, we will give you interest-free, whatever, for 6 months. What are they doing? They're doing financial business, right? So many companies, they are actually in multi-businesses and they are investing in different companies, so in different regions with different currencies, right? So those companies nowadays are getting more and more difficult, complex as well. And investors, right? Most investors, they are not accounting major, if you pay, right? Most investors, they don't have such sophistication to understand different companies, different business, right? And they cannot just rely on what other people tell them. You see that, right? That's one thing. So even if you look at financial statements without enough knowledge, you still don't understand. And now if we think about other, right? Let me go to the final reason, in my opinion, which would make auditing necessary, is that we think about the issue, right? If companies cannot trust financial information, right? I don't want to go too deep, but let me ask you, right? If you know the company you are dealing with, the company you are interested in might be boosting their performance, might be overstating their performance, are you still going to buy their stock? Probably not, right? If you feel all the companies might be overstating their performance, might be lying, would you still be investing in the capital market? Would you still buy stock? Maybe not, right? Maybe just like what agents do, just buy more land, buy more houses. So we won't. That's my point. If the market itself, if the companies are not trustworthy in whatever they're communicating to the potential investors, the market will collapse. So with all these reasons, right, for everybody's interest, I think there needs to be somebody who has expertise and who can closely monitor the companies and who understand accounting, who understand the company's operations, right, and who won't be biased. To be there, right? To be there and tell people, hey, look, this is what they tell you how they are doing. I can vouch for that. I approve that. Or, hey, this is what they are telling you, but I think it's not true. I think the truth is much worse than what they are telling you. We need somebody like that to tell us. And you won't just take anybody's word for it, because that guy, in your opinion, needs to know accounting very well, needs to know client work very well, needs to be close to the client, needs to be unbiased. Right? Who can that be? It cannot be an individual, right? Because there are so many companies. It has to be some organization. Okay? And we don't. It certainly cannot be anybody from the client, because we don't, you won't trust anybody to go against themselves, right? That's very obvious. And we don't want government really to do that, because, I mean, they're government, right? We don't want them to be interfering in our lives. And we don't, for me, I don't have too much, speaking for myself, right? Based on my experience with USPS, I don't have too much confidence in government's efficiency, okay? So naturally, right, we have audit firms, and we are talking about external auditing, right? We are talking about external auditing to make sure what the company is telling the other people their performance is trustworthy with no material misstatements. That term we'll talk about later, right? So we need auditors, because auditors play such a role. And for auditors needs to be convincing, we can go back, right? Still talk about same thing. Auditors need to have good expertise, insights, enough training, up-to-date training, because they need to be knowledgeable, because accounting is not straightforward. Accounting is complicated, and because clients are complicated. They need to know accounting very well. They need to know their clients very well. They need to know their clients' business quite well, right? They need to be trained, have the expertise. And we also want auditors to be unbiased. How do you know auditors are unbiased? Of course, we are not mind readers, right? So how do we make sure? One thing very straightforward is, if the auditor is financially related to the clients, means that if clients are doing better, they will be better off if they hold a client's stock, for example, right? Or if auditor somehow is closely related, right? Like brothers of one of the high-level management of the client, such things, right? We won't trust their independence, right? No matter what they do, at least they are not convincing in terms of showing they're independent, because, hey, if companies are doing better, then you will be doing better. How do we convince you won't let the clients just be better so you can profit from it, right? Do you see this? And we know that many people would go like a limb for I'm using the term right, go an extra mile, right, for their family. So auditors needs to be independent, needs to be unbiased, right? How do they tell people they are unbiased? Try to be independent first. And what do we mean by independent? Cuts all ties, right? If there's no way for it to benefit, to be better off when clients are better off, right? If there's nothing like your good friend or family, close family member, then people might believe those auditors are independent and then might be unbiased. And we don't have to mention, right? Auditors are different from outsiders. Auditors are like semi-insiders, meaning that they are not treated like clients' employees, but they do see a lot than other people. They're allowed to look at a client's financial statement, accounting information, and process it. But of course, in most cases, they have to keep this information confidential. So compared to outsiders, auditors are very close to their clients as well. When I was an auditor, we go to the clients 2-3 times a year, gather information, talk different things, and we do this every year, right? As a matter of fact, actually I have quite, not friends, but we have quite, a lot of us had a quite good relationship with our clients. I mean, you see other people, right? 2-3 times each year, and each time it's like two weeks at least, right? This might be more often than you meet your brother or sister. So no wonder, right? So my point is, we need auditing, right? We need auditing because people tend to lie, because companies tend to lie. Unfortunately, that's the case, right? And we need auditors to verify, to tell us in a simple term, hey, companies tell us they are doing well or they are doing blah, blah, blah for the past year, how many assets they had, what's the revenue they had, what's the profit they had. I don't know if it's true or not, right? So if you show me that you are independent, you have enough expertise, and you really have internal access, which all audit firms will be granted to the clients, right? So look at this information, do your audit work, tell us whether they are telling the truth or not. If not, tell us what is wrong, what's the difference, right? And tell us how big the difference is. That's all about it, right? That's auditing. That's why we need auditing. So let's take a look at the notes. We're gonna go through at the handout. We're gonna go through it again. Like I said, I don't like reading it. I think the handouts, I put some effort there, really sweat to do this. So read the handouts. We're just gonna go through the most important things. Okay, here's unbiased whatever things, right? So for auditors, like I said, right, auditing objective of financial statement auditing is to make sure, give reasonable assurance that financial statements are free from material misstatements. Reasonable assurance and material misstatements, reasonable and material. We'll talk about these in later classes. For now, we don't have to be too picky about it, right? And when auditors doing their financial reporting, if it's not, they have to report their findings, right? If everything is good, people are appears to be telling the truth, they tell other people, they tell the financial statement users such, right? If not, they tell them what went wrong and by how much. And by doing this, auditors have to have professional skepticism, they need to exercise professional judgment, and they need to have sufficient appropriate evidence, and they need to conduct in accordance with auditing standards, right? What do those mean, right? Professional skepticism, what does this mean? And we all heard about the famous, right? There's one big, like the Oscar winner of the accounting frauds story, and which is Enron, right? Which literally brought down one of the big five back then, Arthur Andersen, one of the big five audit firms, right? And that changed the game forever. Before that, people always say that we have to have professional skepticism. But back then, the auditors always have something that, hey, we are kind of working with clients as well. But all the Aaron's case changed the story forever, right, for good. After that, most audit firms, when they, of course, they still want to keep good relationship with the client, but when people auditors are doing their work, the start point is not, companies are not really given the benefits of the doubt anymore. And they are guilty until they are proved not, right? So this is why we use professional skepticism, meaning that you have to think about what the clients tell you. If you see something that doesn't make sense, gather enough evidence. Think about what are my causes, and think about all the potential answers your client might give to you, right? And then go to the client. And based on what client's telling you, ask them more questions, dig more, asking probing questions until you get what you want and which is consistent with company's financial statement information. Okay? Professional skepticism, meaning that you have to ask, you have to be prepared for clients' replies, and you have to be asking questions, probing questions further and further all the way to the bottom. Right? But a professional skepticism doesn't mean is not the same as being professionally paranoid, right? So you have to stop when you got enough evidence, right? This is called when you have sufficient appropriate evidence. You have to know when to stop, okay? When you have sufficient enough quantity-wise, and when you have appropriate, meaning that they are relevant, they are good to show you what you want, stop right there, right? Don't be paranoid. We don't need you to work 40 hours a day. Right? But when we gather those evidence, how do you know when you have enough, when your evidence is appropriate, right? We have to use professional judgments, okay? And when auditors do their work, they have to follow audit standard. And based on what we talked about, I think the relationship is quite clear already, right? We have clients, or to be more specific, we have management who they are responsible for the company, right? They are responsible to produce financial statements. They are responsible to make sure the company have very good control and they have good financial statement. Right? And so clients also have a committee which will be overseeing financial matters, accounting reporting matter, right? So they produce financial statements, okay? And we also have auditors. Auditors will be auditing financial statements, after they do so, they will produce audit opinion. And we have some other parties like the governments, like SEC, like PCOB, they will be overseeing the auditing process. So I guess many people heard about, in our last meeting, I talked about this already, right? I think it's really great to work as an audit firm. Although the starting salary for a newbie for audit firm, I don't think it's really high, but it's kind of okay, not bad considering you just graduated from college, right? I think you would have maybe thinking you live like a king already, but it's quite good, quite competitive. And of course, they are not top paid compared to a lot of good companies, but like I said, for audit firms, they give you an opportunity for you to learn really fast and for you to see many different industries and for you to really gain insights about the clients you work with. So it's great, right? And we talked about it. A lot of companies, when they hire managers, and they usually want the managers to have worked in audit firms before, for the reasons that I mentioned already. But if you really look at audit firms, right? What are audit firms? We heard about it, right? We have KPMG, Grant Thornton, PwC, and those are, and Grant, right? And EY, Deloitte. Those are large multinational, international. Those are large international professional accounting firms, right? And we have some smaller firms, like I think UHY, right? UHY, right? So smaller firms. And sometimes you go to a plaza, right? And you see people's last name there, right? Those are small, quite small, like single, like a Martinez, like a Blacksmith, LLC, or audit firm. Those are sole practitioner firms. What does it mean, big and small, right? When you have large international companies, audit firms, you have very large clients. You know, when you have local ones, a little bit smaller, more regional. When you are just in a sole practitioner firm, you have secretary, of course, but when you're a sole practitioner, basically most of the things you do, you're auditing small clients and you are doing accounting for a lot of your clients. So like any business, for audit firms, it's like a pyramid, right? They have most junior auditors, then some leave, some get married, some got tired, right? Some worked too much, you know, accidentally no longer there. So there are fewer seniors, right? And after seniors, they're promoted to partner. Of course, fewer for other reasons we talk about. Then after manager, they promoted senior manager, then partner, right? So along the process, you know, it's a pyramid, and the tip is getting sharper and sharper on the tip, smaller and smaller on the tip. When I was working for KPMG, we used to have a joke, right? We said one of the important secrets to be a partner is to outlive everybody. So anyway, but compared to other companies, I think it's a much better form because every year from the pool, they are picking a very large percentage of the pool will be promoted to the next level. Right? This is very rare. If you go to the industry, work for other companies, you will notice that usually those people can give you, your employers can give you a title after you work long enough to make them feel guilty about not giving to you. But it's not easy to be really promoted because usually they don't need so many junior accountants, right? And they don't need so many senior accountants. And those junior accountants, senior accountants, they're gonna be stuck there for a while, right? So unless somebody dies, somebody switches their job, somebody quits, unless, right, your level won't be easily promoted. But it's different in audit firms. So that's one very important difference, and you have to consider it. And for auditing, I won't talk too much. Let's go back to the. I won't talk too much about skills and knowledge. I think we have, the book did a quite good job talking about these already. And to be honest, a lot of those are pretty cliche, right? When you do anything, people always tell you leadership is great, teamwork is great, and you gotta be professional. Right? If you tell people I don't have leadership, I don't like teamwork, and I don't think professional skills are important, any of these, right? You won't be hired anyway. So, I mean, it's kind of cliche to me. And this one, organizations that don't look down upon those, right? I agree with you. Those information, those things are boring. And when you prepare for CPA, you're probably going to have forgot. You're probably going to read it again because you forget it already. But don't overlook this. Those are important. Why? Because sometimes these might show up on CPA exams. Yes, showing up on CPA exams makes them important to you, not because they are by themselves important, because when you start as a junior, these are not important to you at all. And when you are at the level you're going to need this information, you know these already. You pick them up along the way already. But unfortunately, CPA sometimes test these. So you better keep them in mind, right? So what is audit quality? And let's talk about a few concepts and then we can call it a day. It's been long enough for all of us. I'm happy. So put a long story short, right? Short. Put a long story short. What service does audit firms provide? They provide an auditing service. So what's a tangible product of auditing service? A piece of paper or two pieces of paper, which is called an audit report, which basically tells you whether there are issues with companies' clients' financial statements. And to be more exact, They tell you whether clients' financial statements are materially misstated or not, right? So what is a good quality audit? Basically, the results are good, meaning that what the paper said is accurate. We don't want it to be 100% accurate, but it needs to be very, very accurate. So we say here, provide assurance that audited financial statements and disclosure are presented in accordance with GAAP. We explained already. Accounting, what is accounting? Accounting makes sure giving people enough information to make decisions, right? Like we talked about the PPE case. So we here with this, and providing assurance that those financial statements are not materially misstated, whether due to error or not, right? This is not complete. They are either not materially misstated or materially misstated, and you have to tell the financial statement this. Right? So easy to understand. What can make audit quality better? We have the audit firms. Audit firms have to be honest, have to always keep in mind to improve their employees' integrity and to professionalism and competence for sure, right? And they need to make sure they do a good job. They need to oversee everything, right? And also what's important is they have to look at their clients, right? Because clients are the ones who produce financial statements. Auditors just audit financial statements and produce audit reports. So clients have to be, they want to make sure clients have a good system and if they have good culture, all the things to produce good financial statement as well, right? And also there are other factors, for example, in different countries, because different countries have different culture, and different countries have different legal environment against accounting fraud. Right? Let me use an extreme example, right? If you go to a country where the law says, if you tell the accountants who work for the companies, right, that if any of you have any fraud or make any mistakes, you're going to face death penalty. If you have, as an auditor, if you're lucky enough to work in such a country, your job is going to be extremely easy. But I bet, if not all, most people won't commit any fraud, and they will be extremely careful when they are doing their accounting work, because if they make mistakes, they die. Right? So legal environment is important as well. I'm not going to spend too much time go through all these. So after what we have discussed, right? We can assume we can know that for auditors, they provide auditing service. They produce and their opinion about whether financial statements of the clients are good or not, and by how much not good, they're presented on a piece of paper or sometimes two, which is called audit report, right? And when we talk about audit reports are good or not, when we talk about audit quality is good or not, we are really talking about whether the opinion given on the piece of paper called the opinion is accurate or not, right? So what's the risk? What's the nightmare of auditors, right? Their opinion is incorrect, right? So here we have audit risk. Audit risk is the probability that the audit opinion given by the auditors are not correct or are incorrect. That's audit risk. Audit risk is a probability that the audit opinion given is incorrect. Right? So what affects this? We can think about it. We talk about it, right? Who's involved in the auditing process? Okay, auditors are definitely involved. Clients are definitely involved, and there are a few issues environment-wise are involved as well, right? So if it's purely about the legal environment, like how harsh a country's law is, or if it's about the nature of client's business, right? I mean, we all deal with electricity companies. Electricity business is heavily regulated. They cannot charge too much profits, and how much everybody used, all the clients used, they are run through the meter, right? So there's not too much room. There might be low efficiency, but there's not too much room for fraud, right? So if you work, other things being equal, if you work with a client in this type of business or with a client operating in a country with extreme law, harsh law, or other factors, right? Those, and you would see that, okay, other things being equal, all the risk is much lower. Can we see it, right? So what makes all the risk? First component is inherent risk, we call it. What is inherent risk? If this is a risk factor that neither clients nor other firms can change, then this is called inherent risk, right? Clients, Walmart choose to be in retail business, grocery business, right? Walmart cannot change that. They're there already. Walmart's management cannot change that. Otherwise, they're going to be fired, right? So they cannot do that. Auditors, of course, they cannot tell their clients that, hey, don't do that anymore. They're just auditing financial statements. So industry is one of the inherent risk factors, right? Some industry is safer with less fraud, some industries with more. You can see it. And so after these factors are taken into consideration, what's the second factor, right? Second factor is clients. If client has a clean history, has very good accounting knowledge, has very good accounting system, and has very knowledgeable, friendly CFO, right? Other things being equal, this client is much, much less likely to have misstatements. And if this clients are much less likely to have misstatements, it means auditors, their job is much easier, right? Other things being equal, the audit risk is much lower because auditors won't have to be worrying about being misled, right? So we call this control risk. Control risk basically means the risk factors only client can affect, right? But other people, auditors cannot, right? For example, a control risk factor here means, okay, we only hire students. When we hire accountants, we only hire those with GPA 4.0, or we only hire those with with CPA license, right? This is a rule, right? Only client can enforce. Other people cannot mandate client to have such a rule, right? But with such a rule, if client mandates such a rule, maybe their accounting team is more competent and their financial statements should be better. So auditors cannot change that. Auditors cannot recommend, cannot command, cannot order clients to hire somebody and not to hire somebody. Only client can do this, right? Auditors cannot affect such. So keep in mind, right? So this is one example of control factor. Control factor is about client's rules, policies, which is related to the quality of financial statements, right? Now let's talk about third, right? We talk about those nobody can affect, and we talk about those only clients, the rules, right? Now it's about auditors. It's called a detection risk. And what is detection risk? Detection risk is a probability auditors, after they do their work, they still cannot catch misstatements, right? If you cannot catch misstatements, then your audit risk is really high, consider your opinion is wrong, right? So detection risk is a probability that after hard work, after working, auditors cannot catch misstatements, material misstatements. So that being said, it's very easy to understand what are the factors to reduce detection risk, right? You hire better people means more experienced people with higher integrity, those people, and with more insights about the particular clients. And in addition to that, you can also assign more people to do the job, to do better, right? Or if you have more competent employees, right, who has CPA, who has more experience, so those factors can reduce detection risk. So we are concerned with audit risk, as you can see, but audit risk is really affected by inherent risk, control risk, and the detection risk. Okay. So this is the end of today's class. Let's just call it a day. So that's all for our class. Let's just call it a day. If you have questions, like I said, don't hesitate to shoot me an email. Okay, I'm working on the CEngage website homework, so I'm trying to assign more work to it. I will make more announcements about homework. So just keep an eye on Blackboard for announcements from me. All right, guys, take care.